Okay, let's talk about options trading made easy, your guide to profitable trading. I am using some excerpts out of this one from a book. It's called Options Trading Made Easy, Your Guide to Profitable Trading by Guy Cohen. And I recommend reading this. It's a very good book for beginners. And I wanted to clear up some of the terminology confusion going on around options. It's very simple. Let's go ahead and go through this. And again, references from this video originate from Options Trading Made Easy, written by Guy Cohen, and he is the creator of the OVI indicator. So, introduction to options, excerpt from page 1 here. Why is it that options are so misconceived as a minefield of danger and risk? How can we make sense of this and look at options as tools to limit our risk, maximize our returns, and see what we're doing at the same time? Options have become remarkably popular, especially in the United States, far from being confined solely to the institutions and professional money managers. Options trading is now mainstream for retail traders from all walks of life. The concept of options is still, however, treated with fear and trepidation in some quarters. The simple fact is you need to have a trading plan that works. It needs to keep your risk low and your potential for reward high. You need your plan to have structure and simplicity so you can follow it every time, do what works. To make it as a trader, it helps to develop the following traits, and they can all be developed. Qualities a successful trader should possess. Patience. I tell my group this all the time. Quote, there comes a time when you feel at one with the markets and trade only when the most obvious of opportunities stares you in the face. When you are able to turn down substandard opportunities with a shrug of the shoulder, you'll know you've arrived. Consistent with the art of patience is embracing the concept of compounding. If you can take just 1% per week, this would mean more than 67% in just 1 year, a record of which any fund manager would be envious. Perseverance. Quote, if you believe in something, you have to keep at it until you reach your goal. And once you've reached your goal, set another one. So you got to keep trying. You're going to get knocked on your feet or you're knocked on your butt, and you're going to have to pick yourself up. And you have to learn from your mistakes. We all make them. They're just a natural part of learning. Next, we have knowledge. And this is one of the most crucial parts. There's never been a better time to gain knowledge on some of these topics than in today's environment. Remember that learning is experience-based, also very important. The same applies to trading. A lot of the learning involved in trading is experience-based. You're not going to know how to sell calls. You're not going to know how to trade options unless you get experience. In fact, the most pertinent form of learning about trading is experience-based. It's through the extreme experiences that you find more out about yourself in good times and in bad. Most brilliant traders have had terrible experiences, but crucially, have stepped back up to the plate and applied what they've learned. Honesty. Quote, you have to be honest with yourself if you're to develop into a decent trader or investor. Ultimately, your results determine how good you are. Your decisions are your responsibility and not anyone else's. Blaming other people never helps. If you pull the trigger, then you're the one in control. Unquote. And discipline. You practice pre-planning and risk management. Use your experience and the experience from those around you to learn from mistakes and better yourself as a trader. You do not deviate from your seated, sensible plan. Do what works. Scatterbrain logic will not help you meet consistent success. And what is pre-planning, by the way? Pre-planning is basically, before each trade, just make sure you are aware of your maximum risk, maximum reward, break-even points, your entry point, your exit point, and whether that exit point is to take profit or stop losses. So, this is where it gets a little confusing. What is an option? I'm going to try to break this down in a compartmentalized way to make it very simple. Let's dissect the definition of an option. An option is defined as the right, not the obligation, to buy or sell an asset at a fixed price before a predetermined date. Now, using that definition, let's break apart its components, which are the right, not the obligation, to buy or sell an asset at a fixed price before a predetermined date. So let's focus on the right, not the obligation. This is where everyone gets confused. So buying gives you the right. A call is an option to buy. buying an option, call or a put, conveys the right, not the obligation, to buy or call or sell or put an underlying share. When you buy an option, you are not obligated to buy or sell the underlying shares. You simply have the right to do so at the fixed or exercise strike price. Your risk when you buy an option is simply the price you paid for it. So, let's recap that. Buying gives you the right. Buying an option, and you can buy a call or a put, conveys the right, not the obligation, to buy or sell the underlying shares. Now, when you buy the underlying shares, that's going to be a call. When you sell the underlying shares, that's going to be a put. Now, when you sell, you're imposing the obligation. So when you buy, think about it, when you're buying something, what are you buying? You're buying the right. You're getting something in return for buying something. The thing you're getting in return is the right to buy or sell those shares at the predetermined price at the predetermined date. Now, if you turn around and sell options, all of a sudden, you're not buying anything, right? You're selling. So if you're not buying the right anymore and you're selling, you must be selling or imposing the obligation. So you're getting money up front because you're imposing an obligation on yourself, which obliges you to either buy from in the form of sold puts or deliver to in the form of sold calls to the option buyer if he or she exercises the option, which can only be done if the price is in the money at or before expiration. Literally the exact opposite of when you buy something. So when you buy a call, you're buying a right. When you're selling a call, you're selling that same right to someone else. And here is a great memory tip. Think about it this way. Think of calling up a friend on the phone. The reason it is named a call is because when you buy a call, you can call the underlying asset away from the person who sold the option to you. Put is to sell. Think of putting your pin down on the table and walking away. The reason it is named a put is because when you buy a put, you can put the underlying asset to the person who sold the option to you. So, when you buy a put, you're putting the underlying assets to the person who sold the option to you. Because if you sell a put, your goal is to buy shares. So when you buy those shares, they put those shares to you when you exercise it. It's literally all it is. Now, to buy or sell an asset. Therefore, by what we just learned here, with the putting down, calling up. If you want to call up, you want to call away shares. If you want to put down, you want to put the shares to someone else. Now, therefore, a call option is the right, not the obligation, to buy an asset at a fixed price, which is the strike price, before a predetermined date, which is the expiration date. A put option is the right, but not the obligation, to sell an asset at a fixed price, which is the strike, before a predetermined date, which is the expiration date. Now let's look at a fixed price, which is the strike price. If you buy a call option that at a strike price of 50, then you have bought yourself the option to buy the asset at a price of $50. If and only if the stock is above $50 before expiration or in the money. However, in the real world, you want to exercise your right to buy that asset only at $50 if the underlying asset is actually worth more than $50 in the market. Otherwise, there would be no point. It would mean buying the asset for $50 when it's only actually worth, say, $40 in the marketplace. No one would do that because they could buy it for $40 in the marketplace. This is why most traders never exercise their options, as it costs out of pocket 99% of the time. Because remember, if you buy an option, if you're selling an option to someone and someone's buying an option from you, do you really think they're going to front more money to exercise that call? Because remember, they haven't taken profit because they still have it open. It hasn't expired worthless. So you have two options. You can sell for profit or you can exercise. 90% of people take the profit. And before a predetermined date is the last component of the definition of an option. This is the date before which the option can be exercised. At expiration, the call's option own value is worth only the price of the asset less the strike price. And at expiration, the put option's own value is only worth the strike price less the price of the asset. For U.S. equity monthly options, the expiration dates fall on the Saturday after the third Friday of every month. Weekly options have gained in popularity, but they are still not quite as actively traded as the traditional monthly options. Now, again, I'm going to try this one more time to clear up the confusion between selling calls for profit and selling covered calls for premium. Now, I understand that you can write calls. Call writing is a thing, but you can't escape the fact that you have to eventually sell that call to someone else. Let's go back to the basic definition of an option. An option is defined as the right, not the obligation, to buy or sell an asset at a fixed price before a predetermined date. When buying to open, you are buying the right, not the obligation, to buy or sell an asset at a fixed price before a predetermined date. This means that what you are buying, what you're paying for, is the right. You're paying for the right, but not the obligation. Your options, when paying for this option, gives you the options to buy or sell an asset at a fixed price before a date. You are buying debit. You are taking money and giving it to something else. The ability to call or put shares of an asset at a strike price before a predetermined expiration date from someone else. When selling to open, you are selling. What you are selling, sorry, that should be selling and getting paid for. Sorry about that. So when selling to open, you are selling, or what you are selling, or what you're getting paid for, is you are selling that same right that you just bought a second ago. You're now selling that right to someone else. So pretend that you are on the other end of that transaction, and now you're selling to yourself. And again, your options here when selling are to call or put an asset at a fixed price before a predetermined date. You are selling, or you are receiving a credit, the right, and imposing the obligation to either buy from in the form of sold puts or deliver to in the form of sold calls. So I hope that makes sense. But anyways, that's the intro to options. Remember, selling options is not closing positions. I think that's where we're getting confused here. Selling means you have shares most of the time. So what are you selling? You're not selling the shares, you're selling the right to buy those shares. That's it.